Welcome back to Tax Crunch. My name is Christopher Volis, and today's video is part of a series on S corporations. Today's topic specifically is on reasonable compensation. In other words, now that I own an S corporation, what wage should I pay myself that will satisfy the IRS requirements? Now, as I mentioned in the other videos, an S corporation is a pass-through. So after I pay myself a wage, whatever profits remain are taxed on my personal return. This is as opposed to a C corporation, which after my wages, whatever profits remain are taxed at the corporate level. In 2017, with the tax law changes, those corporate tax rates were reduced to a flat 21%, whereas in the past, if your income was relatively high, your corporate tax rates would be in the 30 percentile bracket. So actually, a C corporation had the opposite problem of an S corporation with the IRS. Oftentimes, the IRS tried to reduce people's wages because the wages would reduce the corporate profits, therefore reducing corporate income tax. So they wanted to keep the wages lower, just enough to keep payroll taxes paid in, but keep the wages lower to generate corporate income tax. And then when the owners would take the money out via dividends, they'd also have to pay a 20% personal rate on the dividends. That problem has become a little bit mitigated because the corporate tax rate dropped. So we're focusing today on the S corporation issue, and that is usually how low can I keep my wages so I don't have to pay payroll taxes. There is a separate topic. At the end, I'll discuss if you want to fund a retirement plan, you are going to need higher wages. But for this purpose, let's talk about S corporations that have lower income, and their purpose is to try to keep their payroll taxes down. So the IRS does have a fact sheet, which is really just a bunch of bullet points that you could use to blend together to kind of come up with a number. And generally, this is going to be common sense. So let's go to the fact sheet first and see how this works. Okay, so here is the IRS fact sheet. I will put the web address on the right-hand column to see where you can grab this from. If you were to go down to the second page, you'll see the 9 bullet points they have here. Some factors considered by the courts in determining reasonable compensation. Some of these are going to be more important than others, but let's take a peek and go through them one by one. Training and experience, the first one is important, but most likely if you do own your own business, you probably are experienced. Obviously, the more trained and more experienced you are, they expect your salary to be higher. The second one, duties and responsibilities. This is important because if you have a manager run things and you're not fully engrossed in the business, you're not expected to give yourself as high of a salary. So really it boils down to what do you do for the company?
What would you say you do here?
That's linked to the third one, time and effort devoted to the business. If this is something that you own part-time, or you have multiple businesses, or you have a full-time job, and you don't do 100%, you're not expected to give yourself a full salary.
I'd say in a given week, I probably only do about 15 minutes of real, actual work.
If you are the only person working for the company, it's going to be hard to say that you don't put 100% of the effort into this business. All of the revenue generated by the business would be generated by you. So that would be a little bit more difficult. Dividend history is going to be more for C corporations. S corporations don't issue dividends, they're just distributions. Payments to non-shareholder employees is the fifth one. That matters if you have other people working for you. What do you pay them? If you're more experienced and you're paying yourself less, the IRS isn't going to like that. So if you do have employees, look at what you're paying them. If you do have employees, then you probably already know what the market rates are. So that's kind of ties into what I said before. This video is really more going to be focused for the people that don't have employees and are just working themselves. The sixth point, timing and matter of paying bonuses. That's really just to see consistency levels. Are you haphazardly paying yourself at the end of the year? Is it based just on the profits that are remaining? The seventh point, what comparable businesses pay for similar services? That's actually going to be really important. That's probably the most important one. What's the market rate for what you do and what your background is? We can actually look at that on a number of different websites. So for instance, here's one of the sites, salary.com. You can simply come here. In my prior video, I had brought up an example of a web designer. And if you were to put in a web designer in the location, I'm in Grand Rapids, and get your salary estimate, they will come up with different jobs. For instance, here is a designer level 1. You can view the salary, and they'll have different levels there as well. So for instance, at the lowest level, level 1, they're saying the median salary is $63,000, going all the way up to $74,000, all the way down to $48,000. So this is a pretty big range here. So when you're dealing with reasonable salary, you have to remember they're not going to nitpick over a couple $1,000s here and there. What they're trying to do is they're trying to eliminate the people that are only giving themselves $5,000 or $10,000 a year, and it's severely underpaying their payroll taxes. Anything in this range is going to be considered reasonable, and at least you're going to have a case for it. So with this site, for instance, you could actually change. You can change the level of the job here and go up to a level 2, for instance. Then all of a sudden, the median salary becomes $70,000, and they have, as your experience level goes up, it goes up even higher. But you're still looking for a range here. So if you're trying to keep your payroll taxes down and some of the other factors are in your favor, for instance, you have other people working for you and doing some of those roles, or you're not spending 100% of the time on there, you can afford to go down at the lower level of this range. So going back to the fact sheet, the last 2 points, I'm not real big a fan of the compensation agreements. What good is the agreement unless the numbers in there are fair anyway? The use of a formula to determine compensation. That's what I brought up in my other video as well. Whether you're doing a 50-50 split, saying I'll take 50% of the profits and just make those as wages, it doesn't really make sense if the rest of these factors do not work out as well. So what you're really going to focus on is the comparable salaries, what other people are making, and then what are you doing, what's the time involved, and those factors are really going to boil down to a common sense number that you can live with as your wage.
I don't like my job, and I don't think I'm going to go anymore.
Okay, so now that we have come up with a number based on this criteria that the IRS has issued, now the question is, do we run with that number, or do we actually issue ourselves a higher wage to take advantage of a retirement plan? So the benefit of the 401k for a single owner S corporation, a uni 401k or a solo 401k, you might hear it described as, is you can put a decent amount of money into the deferral portion, and that is $19,500 for the year 2020. And that is not tied to the amount of wages you issue. So you can keep yourself at a low salary, let's say $30,000, and still fund a retirement plan in a 401k for nearly $20,000. Now that might be enough for most people. They may not have enough cash to actually fund more than that annually into a 401k. If you are fortunate enough where you want to put more in, you can tie that 401k to a profit sharing plan as well. That is going to be tied to your wages, and it's going to be 25% of your wages. So in order to get up to the maximum amount, which for 2020 is $57,000, you're going to need to issue a decent amount of wages, over $200,000, in order to get that paid in. But the tax savings you're going to generate if you're in a high income tax bracket with a $57,000 reduction in income is pretty significant. And that amount is going to overrun the extra amount of Medicare tax you're going to pay, payroll taxes, on that higher amount of wages.
Ooh, yeah. I'm going to have to go ahead and sort of disagree with you there.
So this exercise was just meant to come up with a minimum number of compensation, one that will keep your payroll taxes down, potentially allow you to fund a retirement plan, and also stay compliant with the IRS. Obviously, it's going to be best to look at this on a case-by-case basis, as your situation is going to be different than everyone else's. So if you are having difficulty coming up with this number, contact your accountant so you can collaborate and at least be on the same page. So I hope this information helped. We'll see you next time on Tax Crunch.